Hello, and welcome to FX Gates Education. This course is for the newbies in Forex trading. We have made this video to help those who are interested in trading Forex but know nothing about it, and want to learn from scratch. FX Gates is here to walk you through. If you have not subscribed to our channel, consider subscribing to our channel, so that you don't miss the upcoming videos like this and more. Subscribe, like and share, your comments are also welcome. Now let's start right away. Who trade Forex? The Forex market is the largest market by cash volume in the world, with approximately $6 trillion worth of currency changing hands every day. Unlike regulated stock markets which trade in shares of public companies. In trading stocks or futures, you don't need to go through a centralized exchange like the New York Stock Exchange with just one price. In the Forex market, there is no single price that for a given currency at any time, which means quotes from different currency dealers vary. The Forex market is not centralized, and it is best to think of it as a series of fountains or a wedding cake, with the most important participants at the top, with trades cascading down. The market is so huge and the competition between dealers is so fierce that you get the best deal almost every single time. And tell me, who does not want that? Also, one cool thing about Forex trading is that you can do it anywhere. It's just like trading baseball cards. You want that mint condition Mickey Mantle rookie card, so it is up to you to find the best deal out there. Working in order of size from the top down, the Forex field looks like this. Central banks. Central banks are national banks, in charge of issuing and lending the national currency. They are at the very top of the food chain. Governments and central banks, such as the European Central Bank, the Bank of England, and the Federal Reserve, are regularly involved in the Forex market. Just like companies, national governments participate in the Forex market for their operations, international trade payments, and handling their foreign exchange reserves. This means that they have several powers, which when exercised can move the market and their currency dramatically. There are also instances when central banks intervene, either directly or verbally, in the Forex market when they want to realign exchange rates. The banks. The Forex market is decentralized, it is the largest banks in the world that determine the exchange rates. Most of the market volume is traded in the interbank market, i.e. between banks. Banks trade for both themselves and for their clients. The interbank market is dominated by the Big Four, by volume. This is Citibank at 12.9%, JP Morgan and HSBC at 8.8% each, and Deutsche Bank at 7.9%. Banks trade for themselves both as a speculative venture. Corporations. Corporations, like investment managers and hedge funds, also deal with banks. Larger corporations tend to deal with the larger banks directly, while smaller businesses will work with smaller banks. Forex brokers are corporations and fit in this niche in the chain of dealing. Many corporations are multinational or at least engage in international trade. Even if they do not, their profits may be exposed to the risk of fluctuations in currency exchange rates. For these several reasons, corporations need to make currency transactions. And are often at a market disadvantage because they are forced into the market, they cannot always pick and choose when they trade. The speculators. Unfortunately, we are at the very bottom of the chain, trading on worse terms than every other actor listed above. We need retail Forex brokerages to trade, and these brokers may not even be hedging their risk on our trades. If they are, they will usually use a bank for their Forex dealing, which in turn is probably using another bank, which may then finally have behind it one of the Big Four, or Tier 1 banks. At each level, the prices, spreads etc. will slowly worsen. So, who are the hundreds of thousands of people like us who trade Forex with retail brokers? According to survey results presented in 2014, about 70% male, 30% female. Proportion of women highest in Europe, 41% female. Median age of 35, relatively young. 35% in Europe, 40% in Asia, only 4% in USA. Americans have highest average deposited over $6,000. Breakdown by region: Europe 35%, Asia 24%, Middle East 13%, South America 8%. 84% believe it is possible to make positive monthly returns, 30% do. Larger accounts tend to be more profitable. In the next lesson, we will know why we trade Forex. Why trade Forex? Forex is the most traded market in the world, and when you understand the benefits of the market, it is easy to understand why. When traders choose which market to trade, they are looking for optimal trading conditions and the best chance of taking a profit. There are many reasons why millions of traders across the world think that the Forex market fits these criteria, but we are going to focus on the top 9 benefits of Forex trading. Market is highly accessible given that it's open 24 hours a day, and investors interested in trading Forex can make use of far more leverage than they could by trading stocks. Unlike other markets, Forex trading doesn't have to stop when the sun goes down. Since Forex is traded all over the world, trading markets are open 24 hours a day, 5 days a week, so you can trade when it is convenient for you. While the Forex market's daily trading volume exceeds $5 trillion, the US dollar is responsible for nearly 88% of total trading volume, additional BIS figures reveal. This brings the greenback's daily trading volume to more than $4 trillion. One major benefit of having a larger market is that it makes it more difficult for individual traders and institutions to engage in price manipulation, which can cause securities to experience sharp price fluctuations in short time periods. The retail transaction cost, the bid-ask spread, is typically less than 0.1% under normal market conditions. For larger transactions, the spread could be as low as 0.07%. Of course, this depends on your leverage and all that will be explained later. Because the Forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, with a click of a mouse you can instantaneously buy and sell it, well, as there will usually be someone in the market willing to take the other side of your trade. You are never stuck in a trade. You can even set your online trading platform to automatically close your position once your desired profit level, a limit order, has been reached, and or close a trade if a trade is going against you, a stop-loss order. Forex is traded with a degree of leverage, allowing you to take a position in the market with a fraction of the capital you would usually need. As much as leverage may increase your gains, it can also increase your losses, so it's important that you understand the risks of trading on margin. Thanks for watching. All our social media links will be available below the video. You can also visit our website for more. Please don't forget to subscribe so that you can get more videos about trading. Your comments are also welcome, so that we can bring you what you want.